read the problem first. It is problem 31 on page 81. It says on January 1st, 2015, New Tune Company exchanges 15,000 shares of its common stock for all of the outstanding shares of On The Go Incorporated. So it is a simulated consolidation. Both companies are going to continue to operate legally as separate corporations, but in substance, we're one accounting entity. Each of New Tune shares has a $4 par value, a $50 fair value. We need to know that so we can do the journal entry to record the issuance of stock, right? As we do this journal entry right here. The fair value of the stock exchange was considered equal to On The Go's fair value. New Tune also paid $25,000 in stock registration and issuance costs. That's an indirect cost, which will be a debit to APIC. Several of On The Go's accounts' fair values differ from their book values on this date. So this is not a complete list like we've had before. It's just a partial. Pre-combination, so before combination, January 1st, 2015 book values for the two companies are as follows. And then they give you what we've got on January the 1st, which would be December 31st of the year before. Okay, this is nice because there's no revenues, there's no expenses, there's no dividends. It's very sterile. Okay? And it says, assume that this combination is a statutory merger so that On The Go's accounts will be transferred to the records of New Tune. On The Go will be dissolved and will no longer exist as a legal entity. So first of all, we are going to make it a permanent one. That they are going to, and so prepare a post-combination balance sheet for New Tune as of the acquisition date. Well, in Part A then, let's see, the first thing that if we do, not a simulated, but we do, okay, so we don't have to separately incorporate it. I will go ahead and pass this out. So let's look at Part A. This is a permanent consolidation, not a simulated. What I really want to get to is the worksheet in Part B. But let's just look and make sure that we can do Part A. So what they say is the fair value of the acquisition is allocated to each identifiable asset and liability. So we've got cash, of course, is still the $29,000, but the receivables of $65,000 book are $63,000 fair value. Do you see that in your book? So they've just taken the ones that are in that first section, they've used those numbers, and the other ones they've used the book value numbers. Okay, and so they've recorded, they've bought their assets, subject to their liabilities. They paid $750,000. That is 15,000 shares, $50 fair value. The very first sentence, 15,000 shares times $50 fair value. So they did not really a DDES. They don't really need to because it's going to be a permanent consolidation. 750 minus the 723, so there's goodwill of 27. And then they did the journal entries, noticing, of course, that that they do have goodwill of 27 recorded. There's nothing really profound here. Par per share times number of shares is 60,000. $4 par, 15,000 shares. We credited common stock for 60,000, right? And the difference between 750, the purchase price, and the 60 is APIC, 690. All right. So this is a kind of a no-brainer, but because it was indirect costs, stock issuance costs, that second journal entry, debit APIC, credit cash, 25,000. Okay. And so when we do that, our balance sheet looks like this. This is not a consolidated balance sheet. This is just a balance sheet because they bought it, they gobbled up. It's a permanent consolidation. So Part A, we've already kind of done. But Part B says, assume assume that no dissolution takes place. So now we're retaining separate legal identity. Prepare a worksheet to consolidate the two companies as of the combination date. And then how do the balance sheets compare? So we're going to look at what it looks like as a balance sheet of this new tune, or balance sheet of consolidated balance sheet of new tune that has a simulated consolidation. Okay, so the first thing we do is we're going to make sure that we, and I gave you the shell, so you see that you've got a different amount for cash. We took those two journal entries that they did, and the two journal entries would be like this. Debit investment, $750, credit cash, or common stock, $60. We just did that, right? We know that that's the issuance price, right? And then we also had debit APIC of 25 and cash of 25. So what they've done to start your consolidation worksheet, what is changed is these 4 accounts, 1, 2, 3, 4 accounts. So you'll see that cash is no longer 60 because it was changed by 25. So on your beginning balance for your worksheet, it's 35. The 60 in the book minus this 25. Receivables are still just like they are in the book, 150 and 65. Trademarks 495. Music catalog 840 and 60. Equipment 320 and 105. The accounts payable, the notes payable. The common stock is no longer 400 for new tune. It's 400 plus the 60. You see that? We've changed that. Your APIC is no longer 30, but 30 plus 690 is 720. And then the other thing is they've added in this investment in WebStat as an extra line. And they gave you 2 lines because we're going to have, in this case only 2, but up to 4 debits and credits there. Actually up to 5 or 6, but for right now it's only 2. So far so good. So they changed the numbers and they started the worksheet. And now we're ready to do S and A. Actually, we're ready to do a DDES. So we've got our beginning balances and we're ready to do a DDES. And so the DDES looks like, if they haven't done it here, I will. Purchase price or acquisition price or consideration transferred, $750. What is the book value of On the Go? How do we get it? Several different ways. Book value equals net assets, which is assets minus liabilities, or stockholders' equity. Easiest in this one, I think, just to do stockholders' equity, right? Common stock, APIC, and retained earnings add the 50, the 30, and the 190. And you get 80, 90, 270. So we determine our excess to be 480. Yes? Are we good with this? Any questions so far? All right, and then we have some specifically identifiable changes. So I would take that middle of page 81 and I would do my pluses and minuses. The receivables are overvalued in this case. So we've got receivables, a negative 2,000. Are you with me? A negative 2,000. We also have the trademarks are undervalued by how much? Oh yeah, you're right. No, 130. 130, is that what you said? 225 minus 95 is, right? All I care about is the difference between the book value and the fair value for the subsidiary. 225 minus 95. Everybody okay with that? In fact, I'd probably go through and I'd do my math right there for those 5 lines before I did anything else, because that's your DDES stuff. 225 minus 95 is it 130? I just can't do my math in my head. All right. The record music catalog is undervalued by 40?
120.
20? I'm just not looking at it, so I'm asking you to help me here. And then in-press R&D, 200. And then notes payable are overvalued. There's a double negative. And so our liabilities, our notes payable, double negative. If it was liabilities undervalued, it'd be a credit here, a negative, but it's overvalued. So was it 5?
Yes.
Okay. So our total specifically identifiable reasons for this extra $480,000 is, as you do that, 250, 453. Did I add that up correctly? And goodwill is the rest, which is 27. So there's my DDES. Step number 1, are we doing permanent consolidation? Are we doing simulated? We're doing simulated. Step number 2, what percentage? We're doing 100% in both of these chapters. Step number 3, do we need to make journal entries and change any numbers? Yes, we did, and we did. And then we're ready to start our worksheet for the simulated one. But before we go any further, we do our DDES. Any questions on the DDES? Hopefully it's getting boring. Boring is good. Boring means you understand, and you can do this, right? That's why we do it over and over and over and over and over again. We don't want you stuck on that part of the problem. Okay, I'm going to go ahead and erase this, because now I'm going to do my S and my A entry. S stands for subsidiary stock. This last time. The source is the worksheet. The worksheet. We're going to debit common stock of the subsidiary, APIC, if there is any, of the subsidiary, and retained earnings at the beginning of the year, but this is day of acquisition, of the subsidiary, and we're going to credit the investment in subsidiary, which is a parent account. So far, so good. So let's write it out for this problem. I go to my worksheet, and I see that those numbers are 50, 30, 190. Can you see that? I'm looking at the second column, the subsidiaries column. And I'm getting rid of them. And then I add them up, and I credit 270 to investment. And so you can see that S, and please on your worksheet, always label for me. Okay, so I can at least figure out which entry you were attempting to do. Some people do write this out and then put it on the worksheet. Some people do it straight on the worksheet. I tend to do it on the worksheet because that's your source, but that's just me. I would suggest that you do this so that I can, in your test, so that I can come and say, no, your S entry is wrong. No, your A entry is wrong, or whatever. So it's probably good to get used to doing it this way. All I did was put this is a consolidation entry. It's not going to be on anybody's books. We're not going to post it anywhere except the worksheet. Because one account is the parent's general ledger, and the other 3 accounts are the subsidiary's general ledger. You cannot make a half of an entry, so it never gets posted. Right? Just on the worksheet. Any questions about that? do our A entry. The A stands for the allocations from the DDES. In this chapter, we're just doing it the day of acquisition. So these are the numbers we're going to use, including the goodwill. Don't forget goodwill. So we are distributing this 480. We've just knocked off the 270. You see? And now we're going to knock off the 480. After date of acquisition, it'll take 4 entries to do that. But for right now, all we have to do is 2 entries, one for the 270, one for the 480. So here's our 480,000 journal entry. 453 is those 5 things, 27 is that. You with me? And so right now it's debit or credit, and I've got a credit to receivables, right? Of 2. But the other thing, the others are debited. Trademark, 130. The record thing, 120. Research and development, 200. Debit note payable, 5. And don't forget to debit goodwill, 27. Credit receivables, and then all of that is added up again, netted together, and you credit investment. That's your plug. Okay? So you create everything but that investment, then you do your math, and you see that you've got a debit of 480, so now you got a credit 480. Do you understand? And then we post that to the worksheet.
Should the receivables be 478, or the credit and investment?
Should be 480.
But what about but then where your credit equals
Oh, you're right. Well, that must not be 400 and what?
No, that's right, because that one ends in a 2.
Yeah.
The 27 and the 5.
It's got to work mathematically. It's coming straight from your DDES.
What's the last debit? For
Goodwill. Goodwill.
Thank you.
Goodwill. So it's just all of that. What we're trying to do is chip away at the investment. On date of acquisition, all it takes is 2 entries, the S, the A. The S is the book value. The A is the difference between book value and fair value, including goodwill. And so you post all of these. I know I'm off camera now, but that's okay. You post all of these, the A's, debit, 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 credit, credit, right? The next thing you do is you foot both of those columns and you make sure that they both are the same amount, or you put something in the wrong direction. So make sure you do this 752 before you go any further. Make sure your DDES is right before you go to the worksheet. Make sure that debits equal credits here. You understand what I'm saying? We need to make sure mathematically that we are not putting something on the wrong side or whatever. So now I know that I have taken this and I've put it correctly onto the worksheet because my debits equal my credits. And now I can foot across. I can cross foot. So 35 plus 29 is 64. 150 plus 65 minus 2, debit, debit, credit, is 213 debit. Assets have debit balance. 750 plus 0 minus these 2, that should always be a 0. Always, always, always. Your investment goes to 0, and your common stock, APIC, and retained earnings are just the parent. The 460 and the 695, just the parent. And because we don't have any time for revenues, expenses, dividends, it happens to also be for retained earnings. On date of acquisition, you will be eliminating those. These are credits. They didn't put credits on this time. They kept them in positive numbers. Okay. I would have preferred, I don't think I'm accurate. I would have preferred that all of these have brackets around them. so that I could say credit plus debit equals 415. See how that can be confusing? It looks like, bless you, debit plus debit, and you'd add a debit. But you know that notes payable have a credit balance. So that's 420 minus 5 is 415. And that's why on your test, I will make sure they have brackets. Because that makes the worksheet procedures flow better, I think. All right, 400 plus 95 plus 130 is a big number. 840 plus 60 plus 120, 1,020,000. That one just the sum of the two. That one was created, right? So what we're doing, I told you there's 3 things that a consolidation entry can do. It can eliminate, we did that with these 3 and the investment. It can adjust, that's a lot of these, or it can create. And it created the R&D and it created the goodwill. And then you just put your columns, understanding that the double underlines, this plus this does not equal that. Double underlines are down, not across. Okay? Because all of these things were changes to our totals, right? So this plus this does not equal that. Rather, down equals that. And down equals this one, but they are in balance. How are we doing? Good? I do have for you 2 more pages. This is the balance sheet for the permanent consolidation, and this is the worksheet, and also the journal entries that we would make for simulated consolidation. So I'm just giving you what's on the portal, the answers to the problems. I'm giving you all, you've got all the pieces of this.
The final,
We're sure?
on the final one.
So that means that there's not room for Derek. Okay. Don't have to do that, but I did. Okay. Questions about this? This is as you've learned the protocol, you've learned the format, you've learned how to do this. All that happens from this point on through chapter 7 is there's more. That's all. There's just more. You've learned worksheet procedures. You've learned the S and the A. We're just going to continue to add journal entries. Part C does ask you to compare the 2. So what you have is you've got the answer on, it's actually, these pages are numbered. Page 2-20, you've got your balance sheet. Look at your total assets, $2,574,000. Look at your liabilities and equities, $2,574,000. That's on page 2-20. Compare that to your worksheet, same thing. So the purpose of asking you that question is to show you that we can continue to be separately legally incorporated and come up with the same numbers. And that's our objective. On neither one do you have investment in small. On both of them, the stockholders' equity is only the parent. And on both of them, the values of these things that were under and overvalued, it's the subsidiaries' fair market value added to the parents. It's just whether we do it by recording it and making a permanent consolidation, or whether we simulate it. Because you see, in chapter 3, when we get there, after this date, they haven't changed anything. They haven't recorded any of these things on subsidiary. So we're going to have to bring it forward every year. It's a snowball. Right now, there's very little snow. But each year, that snowball is going to grow. And we have to bring forward, because they will tell us in chapter 3 that some of these things are amortized over 2 years, and some over 5 years, and some over 10 years, and we've got to do an amortization for them. And we've got to adjust because it wasn't recorded. Okay. Most likely, the receivables will be gone next year. That will amortize in year 1. Most likely, the note payable, if it was short-term, would do the same, but it may be over 2 or 3 years. So it's not hard, it's just more. Questions so far? Okay, so what have I not done? At this point, we've done a lot of journal entries. I'm going to let you decide. Do you want me to do more problems faster and just show you the answer? Or do you want me to do fewer problems slower and write the answers? Fewer problems slower. Okay? You got it. Let's go to number 20 and 21. Problem 20 on page 76. The following book and fair values were available for Westmont as of March the 1st. And Arturo company is big. Westmont is little. Pays $4 million cash and 2,000 shares of $2 par but $50 per share fair value of stock for all of the common stock in a merger, after which Westmont will cease to exist. So in part, in number 20, we have a permanent consolidation. Number 21, as you see, it says instead they pay a different amount, so it's just 2 problems in one, just different prices. Okay, stock issue costs $25,000. That's an indirect. That's APIC with a credit to cash. $42,000 for legal fees. That's an expense, debit expense, credit cash. They would like the journal entries to record. Remember that they're issuing stock, but they're buying all of the common stock, but they're going to cease to exist, so we're going to record the assets. Okay? You don't really need a DDES since you're not going to simulate consolidation. Rather, we would compare the price. Now the purchase price here is the cash paid, which is $4 million, and the fair market value of the stock issued, $50 a share, and they're issuing 20,000 shares. Okay, so that's another $1 million. So the price is $5 million. Because we're not doing a DDES, no need to, we can just take the fair market value, fair value of the assets minus liabilities, and they're given 600 plus 990 plus 2 million plus 800 minus 80. And when we do that, we will see that they are, I don't know what that is. I don't have a subtotal there. Okay, so somebody add that up, please. 2.71 maybe? No. What did you get? Add up the assets minus liabilities. $3 million, $4 million. Well, since goodwill is 80 or 690, it's got to be 10 should be adding the fair value column and making sure you subtract for the liabilities. And there's our goodwill. Did you get it? 600 plus 990 plus 2 million plus 800 minus 80. 4,310,000. Okay? So then we make our journal entry and we're going to record inventory 600, the fair values, land 990, buildings 2 million, customer relationships 800,000, credit accounts payable 80,000, right? So each of those journal entries, or each of those are debited, except for accounts payable is credited. So far so good. Then we credit cash for 4 million. The stock, par per share times number of shares. It says that the par is $2. We're issuing 20,000 shares. So the par is 40,000, which makes 960,000 for APIC. You with me? So there's your 2 credits there. You got 3 credits: cash, common stock, APIC. And then the goodwill of 690 has to be debited. Put it in there in the debits. There's your journal entry for that. The direct expense is a debit to expense credit cash, 42,000. The stock issuance cost is the indirect debit APIC, credit cash, 25,000. And those are your journal entries. Pretty cool? Some of you still writing. The rest of you could go on to number 21. They're just sensitivity analysis here instead of, are you ready? Okay, we're up to date. So for that one, it's a $4.2 million of cash, no stock. But remember that it was the book, or the fair market value, remember, was 4.351, I think. What was that number that I had up there?
4.31.
4.31. So what do we have here? It's a bargain. So your bargain, which is a gain, is the difference, which would be 110,000, I believe. 310,000 less 200,000, 110,000. This is our new consideration transfer. In number 21, we pay cash, no stock. But it's still the same fair value, 4.31. So we have a bargain of 110,000. We still are going to record inventory at 600, the fair value. Land at 990, the fair value. Buildings at 2 million, the fair value. All these things at fair value still. We don't have a credit to common stock and APIC, it's all cash, 4.2 million. But we have a credit to gain of $110,000. Make sense? You can create this journal entry. It's a complex journal entry, just create it. We also, they said, forget about the $25,000 of cost, but we still have that $42,000, so they dropped off the journal entry. They just kind of changed up a few things. What if this, what if that? Can you not see that in a board meeting before, when you're beginning to negotiate this, well, what if we do $4.2 million of cash? You know, can we get a bargain with $4.2 million of cash? Cash talks. As opposed to, right now we only have $1 million in cash, so we'll have to issue our stock. Well, we know the stock is going to change value. So we'll probably have to add a little bit more stock than we thought we would have to if it was all cash. Do you see? So this is the kind of decision that you go into the board meeting, the directors do, and What if we can get it for 4 million? What if we can get it for 3.7 million cash? We got a big bargain, you see? So they're trying to show you in a small way what it would look like in a board meeting before the fact. Now, obviously, as accountants, we take the after the facts, okay, after it's happened, past tense, and we do the journal entry. But in real life, it's done before. We're going on to number 22 when you're ready. Who needs a minute? Okay, number 22. Following are pre-acquisition financial balances for Padre Company and Soul Company as of December 31st, and the fair values for Soul Company. Well, Soul is small or subsidiary. P, parent. A lot of times they'll do that. They'll give it names so that either it'll be B for big, and they'll say like Brown Company, B big, to try to help you. They don't always do that, but in this case, Padre is big, parent. Soul is little, subsidiary. On December 3rd, and then they give you the stuff. This is December 31st. There are revenues and expenses of Soul Company. So if we're going to compute book value, we got to remember to add, if we do it with the equity, common stock, APIC, retained earnings plus revenues minus expenses, minus any dividends if there were any, and there aren't. Probably easier at that point to do the assets minus liabilities. I probably would do it both ways to make sure I got the same number. Okay, on December 31st, Padre acquires Soul's outstanding stock by paying $360,000 in cash and issuing 10,000 shares of common stock with a fair value of $40. They paid legal and accounting fees, that's an expense. And then they 5,000 stock issuance costs, that's APIC. Determine the value in consolidated financial statements for each of the accounts listed. And so they give you a list of what they want you to do. So remembering when we did problem 31, the numbers are the same whether it's a permanent consolidation or whether it's a simulated consolidation. It doesn't matter. So far, so good. And it would be, we would have to do the journal entry, so let's do the journal entry first. It says they acquired by paying $360 cash. So I'm gonna do the simulated consolidation because then I only have one debit and that's investment in Soul, rather than the assets and liabilities. It would be the same numbers anyway, right? And then I don't have as many lines on my journal entry. So I'm taking the easy way out. Investment in Soul is going to be a plug. We credit cash for the amount of cash paid. Says they have $360,000 cash. Then we had common stock and APIC. It says we issued 10,000 shares, $40 a share value. Well, you have to look up on the information given to see what the par is. The Padres par is $20 par, right? So $20 times 10,000 shares is $200,000. Fair market, so that would be $20 par, 20,000 shares. This would be $40 fair market value minus $20 par value times 20,000 shares. Would be another $200,000. They don't give me the journal entry, but I like starting with the journal entry. They also paid some accounting fees, expense, cash, $20,000. Oh, by the way, that's a total of $760, right? 20,000, 20,000. And then they have APIC of the parent. This is parent journal entries. Padres journal entries. Padre will record these things. 5, and credit cash 5. So now we know that when we start with consolidated balances, it's not the ones that are given here on the piece of paper, right? We have change cash, cash, cash 3 times. So it'd be the 400,000 of Padre minus 360 minus 25, they ain't got much cash left. But I would, if I was doing this problem, I would with pencil, I would X out the 400 and I'd put in the remaining balance, which would be 400 minus 360 minus 25, not much. I would also change common stock. It's going to go up from 660 to 860. You with me so far? Change our beginning numbers. We're going to change ABIC from 70, it goes up to 270. The expenses from 920 to 940. So I take all these and I embed them into my numbers. So far, so good. Then I'm ready to answer the problem. So don't just start, great guns. Take it one step at a time. All right, inventory. We didn't change inventory. So it's the parents' 410 plus the fair value of the subsidiary 260. What they've done in this problem is instead of using a worksheet, can we do it with formulas? So I would say 410 plus 210 plus the 50,000 undervalue. Shortcut is 410 plus 260. All right, is 670. The next one they ask you for is land. Again, you could do 600 plus 130 minus 20. Nothing here for land. Or just the 600 plus the 110 is 710. Are we good with that? Oops. Buildings and equipment. Either 600 plus 270 plus 60 or 600 plus 330, 930. Franchise agreements, 220 plus 220 is 440, right? Goodwill. Well, we'd have to go and make a computation. Even though we didn't need a DDES, they have asked us for goodwill. We could do a DDES. I'll do one for you. Okay. So the price is $760. The book value, and again, I would do the assets minus the liabilities. So that would be the middle column. Okay. 120 plus 300 plus 210 plus 130 plus 270 plus 190 minus 120 minus 30 minus 510. Okay? And the book value, I don't know. Would somebody do that, please? The other way we could do it is do the third column, same thing, 120 plus 300 plus 260 plus 110 plus 330 plus 220 minus 120 minus 30 minus 510. And we would get 680. But what is our book value? Can you give me a number? And let's confirm it. So it's the middle column, assets minus liabilities. $560. Is that what you got, Derek?
I'm still getting it.
If that's the case, we've got 200 as our excess. Okay? And then we're going to list our under and over valuations here. So what have we got? What's the first one we've got? Inventory, 50, right? 260 minus 210. Don't put the 210 down. Don't put the 260. It's the difference. It's the difference, the difference, the difference, the difference. Do subtraction. What's the next one? And it is positive or negative?
Negative.
It is an overvalued. The next one,
60,000.
for franchise agreements,
Building.
building 60. And it was an undervalued, right? Then the franchise agreement,
30.
under or over?
Under.
Okay. What else do we have? Anything else?
No.
No, usually your liabilities are the same value, I mean, for crying out loud, how can you have them be a different number? You owe what you owe, and that's all you owe, and you owe no more. most of the time. Sometimes we've used present value, sometimes we've got, I don't know, whatever, okay? And so when we did that, that should come up net to 120, does it? 110, 140, 120. And our goodwill comes up to 80. And so they've asked us for consolidated goodwill, 80. The other way of doing that is taking your third column and netting that out, and you would get 680. You would subtract 680 from 760, and you would also get 80,000 for goodwill. You see what I'm saying? So you could do 760 minus fair value, 680 is also 80. Either way, if you just want to learn one format, then learn to do the DDES. Let's keep going. The revenues would only be the parents. In a pooling, we were retroactive to the beginning of the year, but not so with an acquisition or purchase method. The acquisition, I'm teaching this is new, okay? The revenues, even though we bought it at the end of the year, we did not buy the revenues from the year. So it's just the parent. The parent did not own Soul during the time they were earning those revenues. So as we're reporting only to the parent's stockholders, it's only the parent's revenues from date of acquisition forward. So if it was like September 1st, it would be the September 1st to the December 31st of Soul. Does that make sense to you? So it's just the parents, 960. The expenses, it's just the parents, 920, but we added this 20 in there. So it's 940 consolidated expenses, right? Retained earnings beginning of the year would just be the parent, which would be the 390. And retained earnings end of the year, just the parent, 410. 410. Which is the 390 plus the revenues minus the expenses, including the 940. Right? Remember statement of retained earnings? This is back to chapter 2 of your principles book. Beginning retained earnings plus revenues minus expenses, which is net income, minus dividends equals ending retained earnings. So 390 plus 960 minus 940 equals our ending retained earnings, 410. How do we do? We're doing good? Let's keep going. We did 23. Your homework is, by the way, don't forget that you have a companion website. You have a website for this book. Okay? And on that website, there's a student section, and you can download the worksheets. If you're asked to do a worksheet, notice on page 78, they ask you for a worksheet, and they have on number 26, right next to it, it has a little Excel. That means you can go on the website and you can download the template Excel file.
Where?
So you don't have to, page 78, bottom of the page, number 26 is an assigned problem. You can go to your website and you can get that Excel file. So it'll put your beginning balances. Okay? And you don't have to do it from scratch. Anytime you see Excel, you've got a file that you can go download. That's the same for number 32 on page 81. It's also an assigned problem. Okay?
Well, it's all about it, pretty.
Good. Good.
Got a little place for your name on the top. You
Isn't that lovely?
fill it in and turn
So
it
you
in.
could actually, and you might want to do it there and print it out and then go to Connect to put it in. Now, probably Connect, my guess is they've got that same file in there.
I also practice tests as well.
So, but you can even print that out without doing it on there and do it by hand like we did today, and then go to Connect and put it in. So once want you to make sure you know that you don't have to start from scratch. Even though it is on Connect. Okay, so let me see, we did. So 24 is assigned. You have a lot of homework for this one. Don't start it at 10 o'clock at night. You won't get it done. Start it now and you'll get it done. 25, 26, 27, we can do 27. All they want is a consolidated balance sheet. We did 31. So the two that I had remaining to do were 27 and 30. Oh, so decisions. I'm going to do 30. So I'm not doing 27, but I would have liked to have done that one. So you might want to at least look at it and look at the answer. Okay? I've tried to be as comprehensive in class time as I can to help you for your homework and your test. But to do that, we'd have to have gone over 27, which we won't have time to do. So 30, bottom of page 80, Safe Data Corp has the following account balances and respective fair values. So safe must be the small, right? S for safe, S for small. Because they're not giving us the book values of big parent. Privacy first, which would be big, the parent, P for privacy, P for parent. Obtained all of the outstanding shares of Safe Data on June 30th, issuing 20,000 shares of common stock having a $1 par, $75 fair. They also incurred 10,000, which is going to go to APIC, right? And 75,000 is going to go to expense. And top of the page, they also agreed to pay 100,000 to the former owners. Here's a contingent. If, and if. Okay, and they've already done your probability and your present value factor, and they got that fair market value of that, today's value, present value, 30,000. That's our contingent consideration. What is the fair value of the consideration transferred? How many of you would like to try to do this on your own? Are you ready? If I do it quietly, so Eric, let's go ahead and turn off our,
The thing?
yeah,